Welcome to Ben's Market Insights. A super busy week for earnings in the US. Something like 45% of the S&P index earnings are being announced this week. We've also got some interesting macro news around Jay Powell, the head of the Fed Reserve. And we've also really going to have a very interesting discussion about the AI supercycle and what we think is happening here and where we are in that cycle. So let's jump in. So the legal proceedings by the DOJ are being dropped on Jay Powell. That would effectively speed the process by which Kevin Warsh, Trump's nominee, is going to be appointed to the governor of the Federal Reserve. No doubt the administration understood that there was a major impediment through this court action, and by taking it away, that might speed the Warsh appointment, and in so doing, reinstate the idea of interest rate declines going forward, because ultimately it's extremely likely that Kevin Warsh will drive for lower interest rates going forward, and we should start to think about potentially 25 to 50 basis points before year end. So quite positive from a market perspective. We have, however, got inflation figures out as well this Thursday. We're looking at expectations of 3.2% for March versus 3% in February. That is significantly above the Fed's target. This is PCE core, which basically they look at very strongly, and that target for them is at 2%. So doesn't necessarily justify an interest rate decline, but we know that certainly the administration is very keen to have that in place. It's also worth looking at, I think, what's happening with the oil price, and we'll have a quick discussion about Iran in just a moment, but it's very likely when you look at the forward price, and we've continuously suggested that when you look at the December oil futures price, it has consistently suggested that people have not expected the conflict to continue for much longer, and that the curve at the outer end is relatively low. Something's changed in the last week or so, certainly since this kind of permanent ceasefire has been put in place, and there's been a steepening in the forward curve, which would suggest that folks are expecting now that oil prices will stay elevated for longer. And I think that actually starts to make sense and is seeping through potentially into these inflationary numbers, and we'll start to see even more of an impact going forward. So it's certainly something to keep in mind. We know that there's a $60 billion rebuild right now in the Middle East for refineries, desalination plants, and various other industrial plants that have been damaged by the war to date. To me, this ceasefire is essentially equates to inaction, and that inaction equates to no changes in the blockade, which in itself is not particularly conducive to seeing traffic beginning to come through the Straits of Hormuz, and that in its own right would suggest that these prices, even without capacity coming on stream, still remains elevated. So the market, I think, is finally realizing that the oil price is going to stay higher for longer, which is a negative. We've also got Eurozone consumer confidence coming out this week. It will confirm, I suspect, the lowest level since late 22. Inflation in the Eurozone is also heading above the 3% mark, and we'll see some of that action this week as well. So there's much more of a stagflation watch in Europe than there is in the US, in my opinion. And that still brings us back to our investment view that the US holds a better position than Europe. And that, I think, is going to be justified by our next discussion when we start to look at the market. If you're enjoying this content, please subscribe and give us a thumbs up and a like. Thank you very much indeed. So this week, we've got Visa, Google, Microsoft, Amazon, Meta, Apple, Eli Lilly, and MasterCard reporting. Those names alone account for some 33% of the S&P index capitalization. So a very significant week, and would certainly start driving direction. We also had Intel last week, which suggested that there's a really new development in the semiconductor food chain, and that's around CPU. Certainly Intel was suggesting that even their written off inventories of older CPUs have now been written back into the inventory book and being sold. So we're starting a not only a memory super cycle, but now a CPU on top of the GPU cycle that we've already got in place for AI a rollout, which is very interesting. And clearly the first part of, i.e. create the logistics and infrastructure that would allow the monetization that would sit on top of that going forward. So it's not surprising that the semiconductor index has been incredibly strong to date, is likely to continue. It has certainly more legs in doing so, but much of that race is done. Who benefits next? We'll have a chat about that in a moment. But let's look at these cycles and have a think about where we could be in the current AI-led cycle. So I kind of decided to think about 3 different cycles in 3 different decades, thought about the top 10 stocks in the Nifty 50, which was really kind of in the mid 60s to early 70s. The top 10 stocks in that period accounted for some 30% of the S&P index. We then had a look at the dot-com boom. And again, that the top 10 stocks accounted for roughly 25% of the index. Currently in the AI boom, which kind of started around 22, 23, we're looking at something like 40% of the top 10 stocks account for the S&P index. So in terms of the length of time that these cycles lasted, so the Nifty 50 in the 60s was a 12-year cycle. The dot-com boom from around 99 to 2008, a 9-year cycle. And we could argue that we're at 3.5 years currently in the AI cycle. Let's think about sort of the valuations of those cycles at peak. The Nifty 50 at peak, which was sort of mid to late 60s, was running at around 18 to 20 times forward PE. The dot-com PE at a peak was running at between 50 and 60 times, very few little amount of earnings being developed at that time. And the current AI-driven top 10 stocks are trading, if we exclude Tesla, which is a significant outlier, at around 25, 26 forward earnings. So already suggesting that we're not completely out of kilter here in terms of the valuation criteria for cycles. The other way I would look at it is through the price, the PE to growth multiple, known as the PEG ratio. The PEG ratio gives us an indication of the dynamics of that valuation, i.e. what the valuation is set against its growth. Anything that's under 1 is very good value. Anything above 1 and continuing above 1 would suggest worse valuation, if you like, going forward. So at its peak, the Nifty 50 top 10 in the 60s was around 2.25 PEG, which would suggest quite a significant overvaluation. In the dot-com boom at peak, we were at about 2.5 times PEG, i.e. higher growth despite the higher earnings that were coming, the higher PE. And currently in the AI boom, we're at 1.8. Again, an interesting valuation versus previous cycles. I think it is also worth pointing out that where I'm going with this is that we are just 3.5 years into this AI boom cycle. I think that the valuation is not particularly tricky at this juncture. And when you consider that this AI boom is really very much a 5th industrial revolution following the automation of the 2000s and the teenies, is itself a major point of the industrial age that we are in. And now we'll kind of touch on the way that a lot of these companies this week are going to have to think about when they announce their results. Clearly, the market has been spooked by the CapEx numbers for AI rollout that's been coming through from the data center providers. I suspect that they'll start to talk a little bit more about their revenue generation opportunities. And there are some really interesting and new ways that they are looking at revenue generation. be it capacity rental sales, i.e. this is what Azure, AWS, and Google do, i.e. rent space in their data centers. And if you keep in mind that a GPU, a Blackwell GPU from NVIDIA, costs roughly 50 cents per hour to operate, but is being rented out today at $4 an hour, you can see that the margins are significant going forward. Meta, in its last announcement, attributes 25% of its revenue uplift to better AI targeting of audience in its advertising business. That's a $50 billion kicker in the last 12 months alone. The whole discussion about whether there is a monetization opportunity from AI is already beginning to present itself. And I think we're going to hear more about that in these announcements, because I think these managements understand that in order to continue to spend the way they are, they need to illustrate that there is revenue generation. There are also different types of pricing mechanisms that are beginning to come through, and we'll talk about that over the next few weeks in more detail. Things like token-based pricing, API tokens, which are coming out from ChatGPT, agentics retainers, and data as a service, where companies with significant data that are collected are now renting those anonymized data to providers of AI pattern recognition businesses to give a better impression of whatever data set that they are working on. So significant moving forward in revenue streams, high margin opportunities, and I suspect we'll hear more about that this week. And then I think the last point I would suggest is that we are in that first stage. It is about the semiconductor upswing at this juncture, because they're the ones who are getting the income coming through from the buyers of the infrastructure, i.e. the data centers and the, if you like, the service providers. The next phase of performance is going to come from those service providers. So I'm still very much of the view that the Mag 7, primarily in the form of Google and Alphabet as the parent company, Microsoft, Meta, and Amazon are very much the beneficiaries over the next 3 to 4 years from this AI boom and the different pricing mechanisms and the different revenue streams that are coming through. Thank you for your time. Have a great week.